The financial plumbing is starting to freeze. Serious liquidity warning signs are flashing red in dollar funding markets, eerily reminiscent of the September 2019 repo rate crisis that almost brought down the financial system. In fact, the SOFR-Fed Funds spread has reached 5-year highs outside of a quarter or month end. To make matters worse, the Treasury still has about $200 billion to refill into the TGA, and this is coming at a time where the reverse repo has been drawn down to basically zero. So here we're looking at a spread, a difference between two interest rates. This is the SOFR Fed Funds spread. Now, remember, this is referring to overnight dollar loan markets. Most average people don't have access to this, but this is critical to understanding how the modern financial system operates. We can see yesterday there was $2.8 trillion, just yesterday alone, $2.8 trillion financed in these overnight dollar markets. Now, SOFR, SOFR, what this stands for is Secured Overnight Funding Rate. You can think of this as a kind of free market derived supply and demand derived interest rate or cost of money. Remember, a dollar has a price or a cost. Most people think that is set by the Fed, and they do set the Fed funds rate, but SOFR is a much more free market interest rate or cost of a dollar, cost of an overnight dollar loan. And that is reflected via an interest rate. Well, SOFR Fed Funds, the purple line here, or the chart we were looking at before, that refers to the difference between SOFR and Fed Funds. Now, very simply, we're going to go back to 2019 and just explain very briefly what happened back here with the 2019 repo rate crisis that almost brought down the financial system. So, put very simply, SOFR, which is again derived from the supply of dollars relative to the demand for dollars. Well, the demand for dollars was way, way, way higher than the supply of dollars within the financial system, within banks, money market funds, hedge funds, these sorts of large financial firms. Everyone wanted dollars. Very few people actually had dollars. Therefore, the price of a dollar loan, or the price of a dollar, the interest rate spiked way above federal funds rate, which is here in white. This is the interest rate that the Fed controls. Remember, it's actually a range, and the way they set that range is the reverse repo award rate or interest rate and the discount window interest rate. It creates a channel or range, and the Fed is basically guaranteeing no matter how scarce dollars get, no matter how expensive dollars get, we will always sell them to you at this price. Reverse repo is saying no matter how cheap dollars get, we will always buy them at this interest rate. And it is the lower bound because they are trying to set a floor in the price of a dollar. Discount window rate, they're trying to set a ceiling in the price of a dollar. Well, the SOFR 2019 repo rate crisis was this repo rate, which reflects actual supply and demand for dollars. The demand for dollars was way higher than the supply. Therefore, the couple people that actually had dollars got to set a very, very high price. And that price was about 9% higher than the federal funds rate. So on an intraday basis, you had the federal funds rate at basically 2.2%, and SOFR, or the free market rate, was as high as 10% on an intraday basis. And so this is what happens when liquidity conditions are too tight, when a dollar liquidity is too low, when there are not enough dollars, but too much demand for dollars, but not enough people actually have dollars. The exact opposite is true when dollars are overabundant. Here we can see that SOFR actually goes negative below the federal funds rate. And this was, by the way, in 2022, we can see SOFR was below the reverse repo rate. Again, the Fed is trying to use this as a guarantee or a floor in the price or the interest rate for overnight dollar loans. And they were not necessarily the most effective at keeping that floor. We can see SOFR went even below the reverse repo award rate, indicating, again, an overabundance of dollars and not enough demand. So it works both ways. Hopefully that makes sense. Here we can see at the low in 2022, the worst it ever got was about 15 basis points below the federal funds rate. That was about the worst that it got. Well, if we fast forward to kind of more recent era, here's late 23 and 24, we can see SOFR spiking above the federal funds rate from time to time. And in fact, if we go even further forward, we can see that it actually does this quite often. Now, here is the important distinction of why this time is notable. Number one, generally when it spikes above Fed funds, it is short lived and it comes down within a day or two. This has been going on. This spike above Fed funds has been going on since last Tuesday. So last Tuesday, Wednesday, Thursday, Friday, and yesterday of this week, SOFR has remained elevated above federal funds rate. Now, why this is important is because this is extremely abnormal for it to last this long, and also because generally these spikes occur at either month end or quarter end. So I've put here in the blue lines are every month end where you had a spike, or every spike that corresponded to month end. And then the purple lines show you quarter end. And as you can see, generally speaking, it happens at quarter end or month end to a lesser degree. And the reason is what's called window dressing, which is basically a way for the banks and the financial firms to make their balance sheets look good, either to regulators or to investors. It's a bunch of tinkering to try to make their financial situation look better than it is. Really, at the end of the day, that is all window dressing is, as a nice euphemism for tinkering around with your numbers. So generally speaking, this occurs at quarter end or year end, and that is generally when SOFR becomes or the price of a dollar goes above federal funds rate. And the reason is demand for dollars. All these financial firms, they need to meet reporting requirements or liquidity requirements, or they're trying to dress up their balance sheet. So the demand for dollars becomes very high. This is common at quarter end, year end, and to some degree month end. Well, as we can see, this spike today is September 9th. It is not month end, and it's certainly not quarter end. And yet, if we look outside of these month end, quarter end periods of time, which is basically every single time SOFR spiked above the federal funds rate, you have to go all the way back 5 years to March of 2020 to find a point in time where SOFR was this far above federal funds rate, and it was not quarter or month end. So again, this is reflecting something is starting to not necessarily break, but these overnight dollar loan markets are starting to freeze up. And again, over $2.8 trillion just yesterday alone was financed in these overnight dollar markets. Now, why this matters, one of the many reasons this matters, apart from tight liquidity conditions and potential things actually breaking, aside from that, it is coming at a time where the Treasury General account needs to be refilled. What this is, the TGA, what this is basically the government's checking account. Just like you like to keep a buffer for expenses in your checking account, the government also likes to keep a buffer, and the amount that they would like as that buffer is $850 billion, which is about here on the chart. Well, the TGA had been drawn down, debt ceiling and various dynamics. So they had drawn down that buffer, and now they need to rebuild it back up. Well, we are currently at about $660 billion. Again, remember, they're trying to get to $850 billion. Well, what that means is they still have $200 billion to go. Now, why this matters is the white line. The reverse repo, this is reflecting not the interest rate, by the way, which is the red line of this chart. This is the reverse repo award rate, or the interest rate for the facility called the reverse repo. This chart is looking at the balance or the level of the reverse repo facility. You can think of it as a tank of sterilized dollars that were excess, right? We printed way too much money in an effort to sterilize those dollars and prevent them from going into the financial system and causing inflation. We created, or the Fed created, this facility called the overnight reverse repo, where they were guaranteeing, hey, we'll buy your dollars, we'll pay you this interest rate, come store your dollars here, earn some interest. And it was a way to sterilize those dollars to prevent them from leaking out into the financial system. Well, as we can see, is basically at zero. We have been drawing down the reverse repo, meaning those dollars, those $2 trillion, $2.5 trillion that were originally in the reverse repo back in 2022, that $2.5 trillion has entered the financial system. Now, the fact that this is basically at 19 billion, that's a rounding error when you're talking about $2.8 trillion per day in the SOFR market. 18 billion is basically a rounding error. You can think of it as zero. So the TGA has to go up by 200 billion, even more than it already has been rebuilt, which is coming from about 300 billion. They've already put a quite, hundreds of billions of dollars back into the TGA for that buffer. Well, they still have $200 billion to go. They can't get it from the reverse repo. Before, which is what's highlighted in yellow, is other TGA rebuilds where they were trying to get that buffer back up. In yellow shows other TGA rebuilds. Well, as we can see, they had the reverse repo. For example, here they had about $1.5 trillion in the reverse repo. Here they had about $2 trillion in the reverse repo. Here they had about $350 billion in the reverse repo. This time they're trying to refill the TGA, but they don't have a tank or a bucket of excess dollars that they can immediately tap. So where are they coming from? Well, they have to come from bank reserves. Now, before we move on to illustrate that concept, here I want to illustrate that generally speaking, when the TGA rebuild is in process, this is generally not a good time for equities. We can see pretty sharp drawdown here in, of course, March, April of this year. This top or local top in July of 2023, and then finally back here in December 2021. Generally speaking, a rebuild of the TGA is a negative for dollar liquidity, and generally financial assets, liquid financial assets like the S&P 500. At least it's not a causal link, but there is a strong correlation that's generally not good for a risk asset. So here we're looking at bank reserves and the Fed balance sheet. Now remember, the Fed balance sheet is this is the value of the assets that the Fed holds. Now, how did they get those assets? Well, they printed bank reserves. That's what we're looking at in white. They printed these bank reserves out of thin air. This is half of the monetary base, or the M0, is bank reserves created by the Fed out of thin air. And then those are transferred to a major bank in exchange for some securities, whether that be mortgage-backed securities or treasuries, debt securities, generally speaking. And just as bank reserves are created, money printing basically, during QE, just as bank reserves are created to then buy an asset from the bank during QE, well, during QT, quantitative tightening, the exact opposite is the case. So I wrote that little note about how this basically works, but quantitative easing creates bank reserves, quantitative tightening destroys bank reserves, and this is how that actually happens. What we can see is the Fed has been engaged in quantitative tightening. Well, again, what this means is they are basically destroying bank reserves. We've gone from about $4.2 trillion in bank reserves down $1 trillion. $1 trillion has been destroyed via quantitative tightening. Now, you might see this little blip, and that'll become important in the next slide. But the important thing to remember, again, is that these cannot, the 200 billion left to go for the TGA, it cannot come from the reverse repo. It has to come from bank reserves, which are already, $1 trillion less than they were at the peak, running at about 3.1 trillion. What that means is that you're going to be taking bank reserves down to about $3 trillion. That'll be important for this next slide. So now we're looking at bank reserves as a share, as a percentage of the broad money supply. So bank reserves are part of the narrow money supply, or the official government money, you can kind of think of it. The M2 money supply is the broad money. So this includes many more definitions of what a dollar actually is. And here we're looking at a ratio. So bank reserves as a percentage of the M2 money supply, we can see at the peak, it was about 20% of the M2 money supply was bank reserves. Well, we are down at 14%. And what I want to point out is, of course, we established that the 200 billion that needs to go into the government's checking account can't come from the excess sterilized dollars of the reverse repo. It's got to come from bank reserves. So bank reserves are heading lower, probably to about 2.9 or 3 trillion, somewhere in that range. Well, M2 money supply, the denominator, is growing. Bank reserves are going to be shrinking. What that means is this white line is going to go down. And the last time that we had bank reserves down at 13% of M2 was here during January of 2023. Well, what happened Very shortly thereafter, the regional banks failed. We had three of the four largest bank failures in U.S. history happen just a couple weeks later. At the peak here, the KRE, which is a regional bank ETF, tracks the regional banks, was down 26% on a weekly rate of change basis. You can see that reflected in the yellow line. And of course, the Fed stepped in. They created the Bank Term Funding Program, or the BTFP. And you can see they expanded their balance sheet because, again, they had to. And bank reserves, as you can see in white, that line went up pretty sharply. Now, this was, again, kind of quasi QE. They didn't call it QE, but it was basically QE in effect, which was a creation of bank reserves above the creation rate of the M2 money supply because liquidity conditions got too tight. And some of this was also caused by a duration mismatch. These regional banks held long-term treasuries. Well, treasuries were in a pretty brutal bear market during this period of time. They had capital needs, right? People were coming, demanding their deposits. Well, they had been convinced by the government to buy these long-term treasuries. When they went to cash those treasuries in to raise dollars to give to their clients, they found that those treasuries had lost a significant amount of their value, about 35%, I think, at the time. And therefore, they failed. They were not able to come up. They were so highly levered, they weren't able to come up with all the deposits of their customers, and they failed. We had three of the four largest bank failures in U.S. history back here in 2023. And again, it happened just a couple weeks after bank reserves as a share of M2 money supply reached 13%. Is that a causal link? Probably not. Is it an interesting correlation that is certainly a warning sign? Absolutely. Because again, bank reserves as a share of the M2 money supply is a useful metric for looking at, again, going to the plumbing of the financial system. This gives you an idea. Again, the M2 money supply, this is kind of domestic money, right? Individuals' money market funds or checking accounts or savings accounts. But bank reserves and the M0 are much more of the financial plumbing. And so looking at bank reserves, which again, we established have to decline in order for the Treasury to rebuild the TGA by $200 billion, can't come from the RRP, so it has to come from bank reserves. Well, we established that's going to take bank reserves down, and we know the M2 money supply is always growing generally. So what that means is that this will reach 13% again. So definitely something to keep an eye on. Of course, here is SOFR over Fed funds, or the spread, the difference between the secured overnight funding rate, which is, again, the free market supply and demand interest rate relative to the federal funds rate. I will just point out the Fed is talking about a 50 basis point cut. Well, the Fed is not talking about it. Market participants are talking about a 50 basis point cut. I want to point out equities are at all-time highs. Average home prices at all-time highs. Gold is going vertical, screaming higher, way past its prior all-time high, just setting a new all-time high every day. A 50 basis point cut sounds pretty wild, given that financial conditions, this is an index that tracks financial conditions, are lower. Therefore, this indicates easier financial conditions, easier money than they were when the Fed started to raise rates. Read that again. So when the Fed started to raise rates back here in 2022, financial conditions were actually tighter than they are now, more restrictive. Money is easier. The financial conditions index is indicating easier money today than it was when the Fed started to raise rates back here in 2022. Credit spreads are a large portion of the financial conditions index. I've put that in blue. Credit spreads were also wider, indicating more risk with corporate debt. So hopefully that was helpful. Again, many risks. The fact that this is not corrected within a day or two is certainly notable. It's been going on really going back to last Monday or Tuesday. And the fact that it is occurring not at quarter or month end, which is basically every other time SOFR has done this over Fed funds, spiked above Fed funds, has corresponded to quarter or month end. It is not. So something is starting to seriously freeze up. Definitely something to keep an eye on. Remember, generally not good for the S&P 500. $200 billion has to go back into the TGA, and it can't come from the reverse repo, which is basically empty. It's got to come from bank reserves, bank reserves are going to go lower, especially as M2 is growing, the denominator is growing. That'll take this back to 13%, which is the last time that we reached that. You had three of the four largest regional bank failures in US history, and the Fed had to come in, expand their balance sheet, and basically quasi QE. So hopefully that was helpful, and I will catch you on the next one.